What you're seeing is the fact that gold has done its job. They had a bunch of gold, they needed liquidity, and they sold it. There is a rush out of euros. There's a rush out of rubles, a whole bunch of fiat-denominated savings instruments into the largest and most liquid market in the world. Just the near-term impact of the Gulf being shut down, and not just for oil and liquefied natural gas, but for helium, for nitrogenous fertilizer, for nitrogen, for refined aluminum. The impact of a prolonged closure of the Straits of Hormuz, as in many commodities, means that the circumstance looking 3 months out, 4 months out, 6 months out, if there isn't a political solution, are fairly dire. Of course, the shipments are constrained, which is a problem. The second is the Iranians have attacked the Qatari export facilities and, in fact, destroyed 2 LNG trains. These LNG trains are what they extract the helium out of.
Helium, I understand, is used in electronics manufacture, semiconductor fabs.
The United States, with the assistance of Canada, could solve that problem. The impact of what we're seeing on asset classes like gold. What you're seeing is the fact that gold has done its job. It is a source of liquidity. There are various entities that have needed liquidity, in particular the government of Turkey, defending the lira against a very strong U.S. dollar. They had a bunch of gold, they needed liquidity, and they sold it. Gold did a wonderful job. During a period of turmoil, it had a bid. The thing that perhaps has many people worried is that a lot of people around the world, rightly or wrongly, blame the U.S. for the conflict. And they think it's ironic that the U.S., having initiated the conflict, gets the benefit of a stronger U.S. dollar. Markets are morally agnostic. The U.S. dollar is the deepest and most liquid market in the world. U.S. Treasuries are the deepest and most liquid securities market in the world. From a conventional perspective, taught by 45 years of experience, the risk asset in the world is the U.S. dollar. I think people are paying attention to what happens between now and 6 months from now, not what happens in terms of the deterioration of the purchasing power of the U.S. dollar over a decade, a luxury which I have and they may not have.
Just minutes ago, legendary investor Rick Rule dropped a warning that most investors are completely missing. Gold isn't rising because everything is fine. It's being sold under pressure. At the same time, money is flooding into the U.S. dollar, global supply chains are breaking, and a single choke point, the Strait of Hormuz, could trigger a shock that hits everything from oil to semiconductors. This isn't a normal market anymore.
The consequence of this rush to quality right now means that there is a rush out of euros. There's a rush out of rubles. There's a rush out of a whole bunch of fiat-denominated savings instruments into the largest and most liquid market in the world. If you look at the strength of the DXY, which is the index that covers the U.S. dollar versus a basket of currencies, you'll see that the U.S. dollar is very strong. Gold is, of course, denominated in U.S. dollars, so U.S. dollar strength often equates to a lower gold price. And, as I say, people have needed gold as a source of liquidity. Ironically, too, well, I guess we covered this, but there has been a flow of funds into, not out of, Treasury securities, particularly short-term Treasury securities. Until the U.S. gives a Treasury auction, nobody shows up. You can expect during periods of time like this, you are going to see U.S. dollar strength. Longer term, of course, a different problem emerges. We have gone from a period in the U.S. where it looked like our operating budget deficit would be $2 trillion to a revised outlook that looks like $2.8 trillion, which is to say the near-term strength in the dollar does nothing to solve the dollar's longer-term problems, which has more to do with the aggregate levels of U.S. debt. It's also worth knowing, Dunnigan, and this is interesting in many regards, despite the preference of our political class, the U.S. government is beginning to lose control of long-term interest rates and, ironically, even short-term interest rates, despite the best efforts of the Fed and the Trump administration to jawbone down lower near-term interest rates. Near-term interest rates are rising. And this increase in U.S. interest rates makes the U.S. dollar relatively more attractive relative to other currencies. So European money and Asian money chases U.S. dollars, near-term U.S. treasuries, in response to higher interest rates too. For me personally, I've been taking advantage of lower gold prices to increase my gold holdings at the same time that I have also increased my short-term U.S. dollar-based holdings. I would note to you, Dunnigan, that I proved to myself in 2009 and 2010 that I was capable of using gold as liquidity. In other words, I was capable of actually selling it and buying more attractive asset classes. I suspect that some of your listeners have a near religious attraction to gold, and they would be unlikely to use it as liquidity. In that case, they can't count it as liquidity. For myself, I like to say I save in gold and I maintain liquidity in U.S. dollars. Right now, I'm very liquid, so you could argue that I actually save in both. But I do note also that I am philosophically capable of selling my gold if there is another investment class that I think represents a compelling enough bargain that I'm willing to draw down my savings to participate in it. You will note, by the way, that the country of Turkey did the same thing. High U.S. interest rates and the strong U.S. dollar caused the Turks to need to defend the lira to maintain domestic purchasing power, and they sold a bunch of gold, which is to say the Turks used gold as liquidity, as a store of value. And I personally do the same.
As I pushed on your one question when you said about North American energy independence, and I said, well, what about the bigger picture of our broader supply chain dependence? I'll do the same about if there was an existential shortage of available physical petroleum because of continuing supply chain disruptions and constraints of exportable oil to supply the needs of mining operations in countries where that's required for mining. Is it possible that you'd end up with kind of this counterintuitive that, oh, we can't get enough oil to do the mining, but that actually causes an increase in metals prices because of exacerbating the already looming shortage of metals to accomplish the things that need to be done?
I think the impact will be delayed, much like I think if the Persian Gulf conflict goes on too much longer, the prices that you'll see for cargoes of oil and natural gas will surprise people, even though they've risen. They've risen in anticipation of a shortage. If we need to begin to ration oil and gas by price, you'll see very different price levels. The same thing I would expect would occur with industrial materials. I think that if we began to experience energy-related shortfalls in copper production or iron production, the first move that we would see would be a sort of a moderate increase in iron and copper prices, the same way that we have seen a moderate increase in oil and liquefied natural gas prices as a consequence of the Gulf crisis. If that circumstance were to continue, if, as an example, the Australians were, and I'm not saying this is going to occur, unable to mine the Pilbara, the biggest iron field in the world, which is completely dependent on petroleum energy, if that were to happen, and you were to experience real production declines out of the Pilbara, then what you would see is iron priced in a way that reflected the fact that supply and demand got balanced by price rather than anything else. In other words, you would see much higher prices. I'm not expecting that we're going to see that, but I think it's something that people need to take into account. Ironically, the other could be true too. It could be that as a consequence of fear and increasing energy prices, that what I believe is an already existent global economic slowdown exacerbates. And that, as an example, base metals prices are impacted as a consequence of reduced demand from a global economic slowdown.
What we're seeing right now is a global liquidity scramble. Countries and investors aren't thinking long-term. They're thinking survival. That's why gold, which is supposed to be a safe haven, is actually being sold. Not because it failed, but because it worked perfectly. As Rick Rule explains, when systems crack, gold becomes a source of liquidity. Just look at Turkey. They sold gold to defend their currency against a surging US dollar. And that brings us to the bigger shift. There's a massive capital flight happening right now. Money is rushing out of weaker currencies like the euro and ruble and flooding into the US dollar and treasuries, the most liquid markets in the world. But here's the twist. A strong dollar doesn't mean strength. It often signals global distress. Investors are choosing liquidity over logic. Now layer on top of that a growing geopolitical risk. If the Strait of Hormuz is disrupted, we're not just talking about oil. We're talking about liquefied natural gas, fertilizers, aluminum, and even helium, a critical element used in semiconductor manufacturing. Here's the part most people miss. Around 35% of global helium exports come from Qatar. And according to Rule, key LNG infrastructure has already been damaged. That means supply isn't just delayed. It could take 2 to 5 years to recover. So this isn't just an energy story. It's a technology and supply chain crisis in the making. And it gets even more complex. Energy shortages could actually push metal prices higher, not because demand is strong, but because supply is breaking down. At the same time, a slowing global economy could reduce demand, creating a dangerous mix of rising prices and falling growth. That's why Rule says we're entering a market with no clear direction. Just volatility. No trend. No certainty. Just rapid shifts driven by headlines. So what's the strategy? Simple, but not easy. Save in gold, but maintain liquidity in dollars. Because if you're not willing to use your gold when it matters, it's not liquidity, it's just a static asset.
I know that your listeners don't want me to say on the one hand and on the other hand, but that's the best they're going to get out of me because I don't know what's going to happen.
It sounds like there are major driving forces that can cause counter currents that could create a lot of volatility in the next period of time. It sounds like there isn't a clear, compelling thesis that really emerges that says, oh, this is a one-way street, one way or the other way. It's like, oh my goodness, there's volatility ahead, probably choppy seas ahead. Any refining on that simplification of what you just said?
No, I think that's exactly correct. I think a lot of what we're talking about depends on whether or not there's a political solution to the Gulf in fairly short order. The impact, never mind the impact of an expanding war, never mind the fact that the current situation risks political and military escalation into something like a broader conflict between Sunni and Shia Islam, among other things. Just the near-term impact of the Gulf being shut down, and not just for oil and liquefied natural gas, but for helium, for nitrogenous fertilizer, for nitrogen, for refined aluminum. The impact of a prolonged closure of the Straits of Hormuz, relative to the importance in the supply chain that the Gulf region has in many commodities, means that the circumstance looking 3 months out, 4 months out, 6 months out, if there isn't a political solution, are fairly dire. And I'm really being kind. Most people haven't paid attention to helium as an example because we haven't had a supply shortage. Many people think of helium as something that somebody puts in a balloon in a circus, and it is in fact that. But it's also an absolutely critical component in the manufacturing and operation of a whole bunch of computer and semiconductor related activities. About if my memory serves me well, 35% of the world's export supplies of helium come out of Qatar. Two things are happening there. The first is that, of course, the shipments are constrained, which is a problem. The second is that the Iranians have attacked the Qatari export facilities and, in fact, destroyed 2 LNG trains. These LNG trains are what they extract the helium out of. So it isn't just that helium shipments will be constrained militarily, it's that the means of production in certain cases have been destroyed and will take between 2 and 5 years to rebalance.
This helium, I understand, is used in electronics manufacture, semiconductor fabs worldwide. When we were talking about U.S. independence in some forms of energy, there have been analysts who've been calling for over a year now, saying people should look to U.S. fabs like Intel rather than foreign ones that are more under contested geographies and that sort of thing. But what about the ability of the U.S. fabs to obtain helium? Is there any concern that, gosh, we all get it from the same place, it's going to affect everybody?
I would suspect that the United States, with the assistance of Canada, could solve that problem. We have underinvested in U.S. helium, not as a policy choice, but rather because Qatari and Kuwaiti and Saudi helium was cheaper. We have a lot of helium in North America to develop, but we have to develop it. Remember that helium ultimately is a gaseous expression of the decomposition of uranium. Traditionally, the biggest source of helium in North America has been the Hugoton embayment in northern Oklahoma and southwest Kansas. That field has been produced for so long, since the 1930s, that it's under pressurized and is falling. But one would expect that the gaseous trends in South Texas, adjacent to the in situ uranium deposits in South Texas, could increase in stature. My money really would be on Saskatchewan. I believe that within 6 to 12 months that you could drill out enough helium in Saskatchewan that North America would be relatively sheltered from the impacts of constrained helium shipments from the Persian Gulf. Now, make no mistake, in a world unconstrained by war, the supplies of helium from the Persian Gulf would be much, much, much cheaper than North American helium. But to the extent that those supplies weren't available, all of a sudden North American helium becomes extremely competitive.
So help us a little bit more. You said you could obtain helium from that region in Saskatchewan. Are there particular companies that you follow that seem to be better positioned than most at being those who could?
There is one that's private, but the truth is that Whitecap or any of the Canadian gas producers could, if my thesis holds true, come into southern Saskatchewan and begin in drilling those gas fields and extracting helium. Yes, I have made a bet in that field in a private circumstance, which is not available to public subscribers. But I wasn't actually trying to hint at anything. I was just suggesting, in response to your question, that North Americans should consider themselves fortunate in that our supply constraints are more policy related than resource related.
This is the kind of environment where most investors get trapped. They expect clear trends, but instead get chaos. The real question is your portfolio built for stability or flexibility? Because in the next 3 to 6 months, that difference could decide everything. If you want more insights like this on gold, silver, and global markets, make sure to subscribe, because what's coming next most people won't see until it's too late.